Ever wondered how the Federal Reserve prints money without a single printing press in sight? It's not about stacks of paper cash. It's a fascinating bit of digital magic that shapes our entire economy. Let's dive deep into how this really works. When you hear the Fed is printing money, it's easy to imagine giant machines churning out crisp new $100 bills. But the reality is far more modern and, honestly, more powerful. The vast majority of money created today is purely electronic. It exists as digital entries in a computer system, not in a physical vault. So, how does it happen? The primary tool the Fed uses is something called open market operations. It sounds complicated, but the core idea is pretty straightforward. When the Federal Reserve decides the economy needs a boost, maybe to lower unemployment or stimulate growth, it steps into the financial markets to buy assets. Specifically, it buys government bonds and other securities from commercial banks. Now, here's the crucial part. How does the Fed pay for these bonds? It doesn't use existing money from a taxpayer-funded account. Instead, it pays the banks by simply crediting their reserve accounts at the Fed. And just like that, with a few keystrokes, new money is created out of thin air. This new money, these brand new electronic dollars, didn't exist moments before the transaction. Think of it this way. A bank sells a $1 billion government bond to the Fed. The Fed, in return, increases that bank's reserve balance by $1 billion. That $1 billion is fresh, new money injected directly into the banking system. It's not a transfer, it's a creation. Okay, so the banks now have more money in their reserves. What happens next? This is where the ripple effect begins. With larger reserves, banks are now in a position to lend out more money. According to banking regulations, they only need to keep a fraction of their deposits in reserve. So, this new influx of cash allows them to significantly increase their lending to businesses and individuals like you and me. This process is what's known as expanding the money supply. More money available for loans means it becomes cheaper to borrow. Interest rates tend to fall, making it more attractive for a company to take out a loan to build a new factory, or for a family to get a mortgage for a new home. This increased borrowing and spending stimulates economic activity, creating jobs and driving growth. It's like adding fuel to the economic engine. The opposite is also true. If the Fed wants to slow down the economy to fight inflation, it can do the reverse. It sells the government bonds it holds back to the banks. The banks pay for these bonds using the money in their reserve accounts. This pulls money out of the banking system, reducing the bank's ability to lend. With less money available for loans, interest rates tend to rise. Borrowing becomes more expensive. People and businesses spend less, and the economy cools down, which helps to keep prices stable. This entire mechanism gives the Federal Reserve incredible influence over the financial landscape. By adjusting the size of bank reserves through these open market operations, they can steer interest rates, influence the availability of credit, and ultimately guide the direction of the entire U.S. economy. It's a delicate balancing act, trying to foster growth without letting inflation run out of control. So, the next time you hear that, the Fed is printing money, you'll know it's not about paper and ink. It's about the silent, powerful creation of digital dollars that flow through our banking system, shaping the financial world we all live in. It's a truly powerful concept that happens every day, right behind the scenes. I hope this breakdown made this complex topic a bit clearer. If you found this interesting, please give this video a thumbs up and subscribe for more deep dives into how our world really works. Thanks for watching, and see you in the next one.